I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are mixed here as we head towards the close of a volatile week on Wall Street. Our very own Jared Blickery standing by with all the headlines. Jared.
Thank you, Josh. Yes, we are mixed today, and we are down for the week, not only in the majors, but some of the small caps, even the mid caps. I'll get to that in a second. First, let's check out the Dow, which is down about 300 points or 0.6%, a little bit off of the lows, which we had at 1 p.m. Eastern today. Here's the NASDAQ Composite looking at gains of about 0.33%. You can see we were highest on the day earlier in the morning, and we actually started out in the red just a little bit. And the S&P 500 largely flatlined here. We're going to call that break even as of the basis, the close yesterday. And the Russell 2000, that is down the most, 1.74%. And we've seen the most volatility this month from the small caps, from the mid caps. And speaking of the mid caps, here's the S&P 400 down over 1%. But what is positive this week, although it's negative today, is the micro caps. That would be the penny stocks. Here's a 5-day total there, still holding on to gains of about 0.5%. And we got to check out what the bond market is doing. And yes, we're going to get to some heat maps and show you what the storm assessment is looking like there. But for the 10-year T-note yield, and let's dial this down to an intraday, just about break even. The bond market is shrugging its shoulders here. 30-year down 1 basis point to 4.84% after some pretty volatile action in the bond market earlier in the week, but that has subsided. Here today, we are seeing energy up 0.9%. Not a surprise. We're seeing natural gas, crude oil, heating oil. Those are surging because of Fern, and then XLB is materials. That is a gold and silver trade. Silver, triple digits. It hit 100 per ounce. Gold is just shy of 5,000 an ounce. Meanwhile, we got financials leading to the downside, off about 1.33%. Industrials, utilities, and healthcare also in the red there. Got to show you what's happening in the NASDAQ 100. Microsoft, a bright spot here, up 4%. Amazon and Meta each up more than 2%. NVIDIA up 1.5%. Alphabet, Apple, just barely in the red there. So is Tesla. And then Broadcom down, closing in on 2%. And we've got some green here. Let's show you what's going on in the software space, some of the bigger names. But we are seeing Oracle down about 1%, Palo Alto down over 1% as well. Want to leave you off on the Dow Jones Industrial Average, where we're seeing Caterpillar, that's down 3.5%. They're reporting earnings next week, and then Goldman Sachs also down 3.5%. But we're seeing some strength in some of the staples, which is what you'd expect due to the weather situation.
Kevin, great to see you. Let's start with Intel here, because I'm curious. I mean, I would love to try and extrapolate Intel out to the rest of the industry, but it is has so many of its own specific issues, challenges, maybe opportunities. So I'm curious, as an investor, is it something that you're looking at, that you own? And if so, what did this report tell you?
Yes, we do own Intel in certain of our Smart Trust UIT strategies. And let's dive into that earnings report that you guys just covered. Let's start with the good. Just in terms of earnings, 15 cents versus 8 cents expected. That's about an 88% beat. That's certainly good. Revenue exceeding expectations. Now, they did disappoint on their guidance, but it's the reason that they disappointed, Jules, that I find somewhat encouraging, because they didn't have the supply to keep up with seasonal demand. Now, if they address those supply constraints and boost their manufacturing, remember all the 3 big entities that invested into Intel in 2025 gives them the capital to expend in those areas. This could work out well for Intel in the long run. However, they're playing a big role right now in trying to nudge into the foundry business. As we know, their biggest competitor in that regard is Taiwan Semiconductor. Taiwan Semiconductor, the largest dedicated chip foundry in the world, with about a 60% market share that boasts NVIDIA as their largest client. So will Intel start to chip away and announce that one big anchor client as it relates to their foundry business, or do they lean more into their chip business, which has always supported and been what Intel is known for? They're taking a risk and a gamble with that foundry business, but we need more competition out there, and if they have the balance sheet to support it, this type of pullback could create an attractive entry point. But of course, Jules, they're trading at about, I don't know, I'm looking at my screen right now, about 82 times forward earnings.
Yeah.
So they're still trading a bit rich.
Gotcha. So maybe you don't want to step in quite yet until we get more information, perhaps on that foundry business. Okay, so let's kind of zoom out then and talk about tech more broadly. We saw this sell-off happen this week. Tech has not done well thus far this year, right? And there has been, continued questions, even expanding questions about the AI trade. What's your current thinking there?
Yeah, my view is that we're still in batting practice of a doubleheader as it relates to the AI revolution, Jules. And batting practice involves all the additional infrastructure investment that we anticipate taking place, not only in 2026, but for the balance of this decade. Remember that NVIDIA CEO, Jensen Huang, forecasted somewhere between $3 to $4 trillion spent on AI infrastructure investment. So the technology sector, those software and some of those hardware plays, I believe will be more volatile in 2026, especially those trading at heightened valuations. But more of the infrastructure plays, the data centers, the cooling solutions, the power solutions, that's where all the money's going to continue to be spent. And that's where I believe there's still growth opportunities as it relates to the AI trade.
And then something else this week, obviously, that we saw was the big sell-off, right? That was prompted by President Trump's Greenland threats and then sort of the bounce off of that. There was an interesting rift this week between retail and institutional in reaction to that sell-off. According to Bank of America, which cites fund flow data tracked by EFPR, we saw institutions, kind of sell on what was going on, but retail investors stepped in. And I'm curious about that rift and whether, buy the dip on Trump headlines, has that consistently been a good strategy? And is that something that people should be doing?
Yes, tariff tantrum round 2, if you will, albeit much shorter lived in 2026 than it was in 2025. And I hope what I could glean from your statistics there is that retail learned a very valuable lesson from 2025. If we recall during tariff tantrum round 1, the S&P 500 was down about 15% through April 8th of last year. Now, had retail investors at that point in time fled the market and rushed to the sidelines because of that volatility, boy, did they miss out on a significant rebound as the S&P 500 rallied, about 39% from April 8th through the end of the year. So trying to time the market, as we always talk about, Jules, is an exercise in futility. What's more important is your time in the market, provided that you're invested with the diversification that meets your risk tolerance. So it seems as though, at least in this short period of time, that maybe retail learned their lesson from last year as it relates to tariffs, but institutional traders perhaps were looking behind those announced and threatened tariffs and maybe a little deeper in terms of other potential bouts of volatility this year, which I think are coming.
Yeah, well, okay, let's talk about those bouts of volatility then, because you, in your latest note, you give a lot of different candidates for triggering that volatility.
I guess we'll start with. Go ahead, Jules.
Well, I was just going to say, I guess the question is, do you just stay in the market no matter what?
I don't know if it's no matter what, right? Because you really have to be honest with yourselves about what your true risk tolerance is. In other words, if the market is moving higher, that doesn't necessarily mean that your risk tolerance should move higher, just as much as if it's moving lower, your risk tolerance shouldn't move lower. You should stay true to your risk tolerance, your investment timeframes, and what your growth and income objectives are. But with that said, think about what could cause more volatility this year. We know that the continuing resolution that was passed at the end of last year to fund the federal government expires at the end of this month. In all likelihood, in my opinion, the federal government may and will shut down again. How long will this next shutdown last? And then we have midterm elections coming up at the midpoint this year. We're going to have a new chair of the Federal Reserve coming in May. What's the outlook for interest rates at that point in time? What about the debt ceiling debate? What about the unknown nature, Jules, of the current tariffs that are in place, the Supreme Court ruling, and what may happen to the tariffs that have already been collected? A lot of question marks. But if we continue to get earnings growth, if short-term rates continue to move lower, if inflation continues to moderate, and if we get all of this CapEx spend continuing to take place, whether it's with respect to AI infrastructure, aerospace and defense, or even healthcare, I think those areas of the market continue to move higher and overcome those reasons for volatility.
Man, I'm exhausted just listening to you list all of those uncertainties.
Think about me. Think about what's going on
I can
inside this
only
head.
imagine. I can only imagine. Kevin, great to see you. Have a good weekend.
You as well.
Payment, but what do you think, Jean?
I'm not a fan either, actually. And there are a lot of reasons why you should allow the money in your 401k to keep growing rather than using it to buy a home. When people think about using money from a 401k for something like this, they're most often talking about borrowing. And the argument that they make is, well, it's okay because the interest that I pay is actually being paid back to me. So it's a bit of a wash. It's not a wash because when the money is out of your 401k, you lose out on all of those years of growth. And when you're using the money for a home, most loans have to be paid back inside of 5 years. With a home, you have 10 years. And if you leave your job or if you lose your job, you're going to be asked to repay that loan very, very quickly, or it'll be treated as a withdrawal, which means if you're not age 59 and a half, you're going to be hit with a 10% penalty and you're going to have to pay taxes. And that can be incredibly painful.
So, Jean, let me ask you, though. So using a 401k plan for a home down payment, you're outlining there, listen, not ideal. But are there situations, Jean, you can imagine where it could make some degree of financial sense?
Look, if you've looked at all of your other options for borrowing and you've eliminated them, you don't have the credit, for example, or you are in a bit of a cash crunch, maybe it could make sense. A 401k loan is going to be a lot less expensive than many other forms of borrowing. And that's the argument in favor of it. But some plans prevent you from making new contributions to your 401k while you've got money out on loan. And that only further puts you in a hole for retirement. One thing we know, and President Trump rightly said, 401ks are doing great. They're doing really well, especially for younger people, because we've got all of these newer automatic provisions in place that automatically enroll people in plans, automatically escalate their contributions until they get to the point where they're maxing out. They move them into a target date fund so they're nicely diversified. All of these things are really important mechanisms to keep you on track for retirement. And if you pull that money out of your retirement fund and use it for another purpose, you're essentially just putting a monkey wrench in the whole kit and caboodle.
Jean, let's zoom out. Got a bigger thing question for you. I'm sure there's some viewers watching right now, Jean, and they're wondering, should I rent or should I buy? What is the smart way to think through that financial decision, Jean?
I'm a big fan of homeownership. I love the idea that when you get to the end of the road and you get to retirement, you will have something close to a paid off mortgage that provides you with another stash of cash that you can use for living expenses or other expenses in retirement. But you don't want to buy unless you know that you're going to be in that home for at least 5, maybe even 7 years. You want to make sure that you've got enough time to absorb the cost of a move, that you've got enough time to make the transaction work for you. And if you believe that you'll be moving within that window, renting can make sense. Renting can also make sense depending on where you're living, the housing stock in that area. It's a really tight housing market right now, and renting does economically look as if it's a better deal in some scenarios.
Jean, I'm sure there's some folks watching right now, and they want to buy a home. Right now, it's not realistic, but that's the dream. Long term, Jean, what are some smart but also realistic tips to save for that dream? And are there also, Gene, programs that maybe you can tap into and leverage for that?
Yeah, 100%. So the only way to save successfully in my book is to save automatically. You set up a separate account for this down payment. You move money into it every single time you get paid. You bank your windfalls if you get a tax refund, if you get a bonus, if you get money at the holidays. Just move that money into that account and start watching it grow. Put it in a high yield savings account so that it is working for you at least a little bit. And then start exploring the first time homebuyer programs in your area. Many states have programs. The FHA has programs. The VA has programs. There is a lot of money out there that goes untapped for first-time homebuyers because they don't understand that they may be eligible for down payment assistance, for lower interest rate loans, and for a lot of other things that can help them get into that first home. The government is in favor of home ownership. That's something that we clearly heard and will continue to hear. But some of these resources are just far too unexplored right now.
Final question, Gene. If I'm looking to buy a home, in terms of time frame, would you say yes, now is a good time? Or for different reasons, Gene, you would say, you know what, better that you wait 6 months or 12 months?
Look, I think that's an interest rate question for many people. I think that interest rates are going to stick around pretty much where they are right now for mortgages. So if you're waiting, thinking we are going to go back to 4% land, we are not going to go back to 4% land. You are better off just figuring out what sort of home you can afford for the long term. Make sure you take into account the cost to live in that home, not just the mortgage payment. And once you find one that works for you, again, on that 5 to 7 year clock, I would say go for it.
Gene, so good to have you on the show today. Thanks for your time. Appreciate it.
Thank you for having me.
Equipment Share, which rents and sells equipment and technology to the construction industry, has raised $747 million in its initial public offering. The company is now eyeing a valuation above $6 billion as we await its first trade. Jabik Schlacks is the co-founder and CEO of Equipment Share. He's joining us now, along with our own Brooke DePalma at the NASDAQ. Jabik, thank you so much for joining us. Talk to me about why you guys decided to go public. I mean, there are certainly a lot of construction firms that remain private and family held, as yours is. So what do you have your eye on through this IPO?
So I think the IPO for us is the beginning of another beginning. We started about a decade ago, and with about 5 of us, we did about $1 million worth of revenue. And today we did about $4.5 billion of revenue, and we have about 8,000 team members. But the scope of the problem in construction, and just for scale, construction is an $11 trillion industry, and people, materials, machines, the technology we've built fundamentally changes how job sites run. And we do think the public markets with a opportunity this big are the best place to do that.
Jabik, you want to expand your business from about 340 locations to about 700 locations. What are the challenges in your way to do that? And what's your message to investors here? How do you plan to do that now moving forward?
Yeah, absolutely. We're expanding from the 350 to 700 by 2030. And about 20 billion of OEC. And if you think of the growth we've done since 2015, growing from that about $1 million a year to the 4.5 billion, that is really that phase of growth has set us up to really transform the industry. And the scale, the scope of the problem, as we discussed before, necessitates a company like us doing it. But it is done very methodically. It's done by that customer pull-through. And we use an organic growth plan, which is a little bit different from the peer group, but it gives us a unique advantage as we scale.
How much of your demand right now is because of data center construction?
So great question. Data centers are a tailwind. It's not a huge portion of our business. If you think of, again, construction, you have trillions and trillions being spent, and that gap in productivity is what we're solving. Data centers and the tailwind of AI is absolutely a tailwind. And that's not only the data centers themselves, it is the power that's needed to generate. If we think of what we did in the US over the last year, the expansion we need, just from a power standpoint, does necessitate more productive job sites. And that's really why we're here today.
Javix, you do have that physical footprint of the business where you're renting, you're selling equipment here, but you also have this cloud-based platform. What do we need to know about that portion of your business, and how fast is that growing as these construction workers, business owners, look to get on board with this wave of AI?
Yeah, what's fascinating in our industry is because of the archaic nature of construction, if we compare it to other industries, even something like farming is about 10 times more efficient than it was in the 1940s. So from the 40s to today, a farmer gets 10 times more done. We look at construction, and we've basically flatlined as an industry since the 40s. And really, that's what we're solving. When you add that connectivity, that gap that we're missing in construction, cost our industry about $1 to $2 trillion every single year. So we are solving that as an industry, and that is changing how job sites get done. And that's a fundamental difference when you're basing at the foundation of technology and connecting an industry.
And Javik, I'm curious, probably the best known public company to investors in this space is United Rentals. And so I'm curious how you all are differentiated from them. Is it that technology piece, or what do investors need to know on that front?
Yeah, there's a lot of really great companies. As we discussed, this is a $11 trillion industry every single year. And there's a lot of companies solving problems. I think really to that question, the DNA of Equipment Share, how we solve those problems, starting at that data level, that data, that transparency, is really the core difference. And then that enables a unique way for us to grow organically. Instead of buying that growth, you can grow organically. So it is a fundamentally different model, but you have to have the technology layer to unlock the value and grow organically.
Javix, really quickly, I just want to ask, with all this tariff negotiation still ongoing, I've been speaking to so many executives where the costs are higher, and also in addition to that, it's changing the way that their consumers, their audience, their buyers are shopping. One, how have tariffs impacted your business here over the past year? And two, has that changed the way that your consumers, are they renting more? Are they buying less?
Yeah, I think that's a really, really good point. When you have tariffs, when you have economic uncertainty, when you're running a business, our customers, they go to value. They need to do jobs more efficiently. They need to understand what's happening on the job site. And that's where that T3 technology unlocks such a value for our customers that they're able to extract more value for their clients, bring more value, run safer job sites, run more efficient job sites. And they are in business to make money, so they can make more profit. And we think of tariffs, when there's uncertainty in the market, you tend to buy less stuff. And really, our business model, we already have the machines. We have about 8.5 to 9 billion of OEC, and that allows you to power these job sites without having to deal with the uncertainty of tariffs and supply chains.
Javik, thanks so much. And Brooke, thanks as well. Appreciate it. The World Economic Forum in Davos winds down today. The conference was dominated by headlines from President Trump, who used the conference as a platform to advocate for the U.S. controlling Greenland. As the president returns to the U.S., for more on what the top economic issues to watch from the administration are, let's bring in Ed Mills, Raymond James Managing Director. Ed, it's good to see you. So as we sort of consider all of the hubbub over the course of the week in Davos, I am prompted to ask whether really anything is fundamentally different now than it was at the beginning. I mean, we knew that Trump wanted Greenland. That doesn't, I'm curious what you think has changed.
Yeah, Julie, I think what was really interesting and where I got the most questions here at Raymond James was there was an expectation that the speech by President Trump was going to be very domestic focused about affordability, a lot of details about housing, about credit cards, maybe about energy. And the vast majority of it was about geopolitical risk. I do have a lot of questions about how much of this is about near-term priorities, how much of it was potentially a diversion. There is a carrier group going to the Middle East. Iran still is very much high on the list. So coming out of this, we are going to see where this flows. President Trump is in Iowa next week. Are we going to come back to those domestic issues, or are those geopolitical issues going to remain front and center for investors throughout 2026?
I talked to a peer of yours earlier in the week, right after the speech. You said that maybe the speech was a bit of a dud from that perspective, that there wasn't anything new on the sort of domestic policy front.
Yeah, so I was getting a flood of inbound client calls here at Raymond James about what exactly was going to be there for housing. How much was this going to be about expanding supply, lowering mortgage rates? Were we going to have an announcement that you can use your retirement funds as a first-time homebuyer to possibly get that? What was going to happen with restrictions on single-family rentals? Last week, a lot of the client questions were on credit cards. Were we going to see a push again for that 10% cap? Were we going to shut down some of the fees that credit card companies and networks charge? We saw that in the speech, but that was on the back end of the speech. I don't think that's over just yet, Julie, but I do think it is second to the geopolitical issues. I do think that the breakthrough this week was about the fact that we started off with a tariff threat against a number of European countries. That has been removed. Greenland, there is a structure of a potential deal with the NATO Secretary General. I don't think that really fundamentally removes the Greenland question from a lot of investor minds. But really what the concern was is we were probably at consensus that we were at or near the top for tariff rates. But if we were starting to renegotiate some of these tariff deals, were we biased higher? I think that's where investors really didn't like that on Monday and where we saw the sell-off. But when we got the removal of those February 1st and maybe June 1st escalation of tariffs against European countries, that's where we saw the market rally. And the relief from that is that kind of extreme position only to pull back, kind of practice that President Trump uses quite frequently back. Probably.
Yeah, I mean, again, it feels like it's all just sort of continuation, right? We're still watching the credit card thing. We're still watching the housing thing. We're still watching him use tariffs in this way, right? So on a geopolitical front, we also had Mark Carney, of course, of Canada, talking about this global rupture and that other nations sort of need to acknowledge that things have sort of fundamentally changed. But that being said, does that mean that countries are going to change their approaches to the United States? And are there economic and trade implications from that?
Yeah, Julie, I would argue they already have. I think it was really striking that Carney was willing to continue this view. This is not the first time he's highlighted these issues, but it was really kind of important for him to do this after President Trump's speech, where President Trump really called out Carney, called out Canada, really challenged them. Last week, we had Canada sign a deal with China related to more agricultural purchases for the ability to drop the restrictions on EVs coming into China, going from 100% tariff down to a 10% tariff. Trump responded with, oh, that's exactly what they should do. But we really do need to watch closely. Are we moving away from what has been a very good trading relationship here in North America between the United States, Canada, and Mexico to a more bifurcated trading relationship? That would have a much bigger economic impact than anything that we're talking about related to Greenland.
Ed, I'm really struck here because I'm seeing headlines as we're talking that silver is making a new high above $100 a troy ounce. Gold, as we know, has broken out. And there's really this interesting disconnect between equity markets, which have largely held up okay, and commodities markets, which are seeing a lot of inflows, which would seem to say that people are concerned about the things you're talking about.
Yeah, they are. And what I would highlight there, Julie, is not necessarily some of the retail purchases of this, but really what are central banks doing? And I do think this is probably one of those risks that we need to pay attention to. Here at Raymond James, we're starting to get questions. If a central bank starts buying more gold, and maybe not the same level of purchases of U.S. Treasuries, is that going to be a flare-up? Are we going to see tariff threats from that? Are we going to have to relitigate some of those issues? Secretary Bessent had gone after a report that there was another investment bank out there saying that should probably be that rebalancing out there. If that rebalancing starts happening, expect for all of these trade fights to reemerge in a way that I don't think this market is thinking about just yet, Julie.
That is a fascinating thing to certainly pay attention to, Ed, and we will. Thanks a lot. Appreciate it.
Thank you.
Guys, thanks for being here. So we see these Intel shares pulling back today. As we look at that reaction, I'm curious what you think was revealed that was new in these numbers that is accounting for that disappointment, given that we've gotten some guidance around what Intel was expecting. Cody, I'll start with you.
It really was just the disappointment in their supply availability. They really realized the strength of demand of the server side much too late in 25 to start wafers earlier. They didn't start them until Q3 and Q4, so that availability of new product won't be available for them until the end of Q1, which accounts for their disappointment for the first quarter's outlook. But I do think that sets the trough for the year, and then as supply improves, they are able to better meet that demand as the year progresses.
Matt, what do you think here? Because, in the October call, Intel had sort of signaled this. Was it just that, but the stock has been running up, obviously, into these numbers. So what do you think around the messaging versus the stock action here?
Yeah, I think that it wasn't a messaging problem. I think rather that investors had gotten really hopeful that you start to see 18A ramp and there would be some pretty immediate benefits in terms of revenues and gross margins, particularly given a backdrop where, again, you're seeing constraints, you're seeing pricing rise. Those things typically lead to, higher gross margins, not historic lows. And so I think the stock just got ahead of where management's message was.
Now, guys, obviously the supply chain is an issue, but I guess the question is, should they have managed for it better? Now, your peer over at Bernstein, Stacy Rasgon, seems to think so. He wrote in a note in reaction to the numbers, he says, yes, the server cycle seems real, but the company appears to have woefully misjudged it with their capacity footprint caught massively off guard. Cody, do you think that Intel should have done a better job?
I think they should have. I think that's a fair argument that they said that their customers misforecast their own unit volumes heavily through the second half, and that accounted for their shortfall. But given the strength that we've seen through AI throughout 25 and what we've heard from NVIDIA and AMD, I think that the messaging was clear that demand was going to be strong. Intel was basically estimating based on their customer outlooks, and that at least accounts for the shortfall. But I think they could have managed it better.
What do you think, Matt? And do you have confidence that they are going to address this and manage it better going forward?
There was a step function change in August, September that no one saw. So you missed it on the memory side, you missed it on the compute side. So I don't blame them per se for not understanding where demand was going to be. I think that the struggle on my end is simply how do we model all their new products, their new processes, and it's not clear to me what the change from here is, for instance, in terms of gross margins and how they return to historic levels of profitability, and that's the difficult piece for me.
Cody, by the same token, you are actually a little bit more optimistic on the stock, at least judging by your price target increase there. So what's your reasoning behind that?
Julia, I think it's a matter of the rate of change from here. That once you set a trough for Q1, that as they accelerate through the rest of the year and availability improves, that they get the benefit of their first shipments of 18A and the volumes and the pricing benefit, the margin benefit that new advanced process will hit their model as the year progresses. I expect they also, as the year goes on, they also are able to finally talk about new customers for their 14A program, and that will be the big catalyst for the stock, is if they can finally set a base for an ongoing foundry business.
I mean, all of this said, Cody, the stock run up, I mean, I guess you could argue some of it is optimism in what you're talking about, but a lot of it also had to do with, the president saying he met with Lip-Bu-Tan, the sort of external investment from SoftBank and others in Intel. And so when you look at the valuation here, given that it was sort of puffed up by some of those elements, how do you strip that out from where it should be valued here?
I think that there is been a lot of hype and over exaggeration of maybe the momentum in the short term that obviously accelerated the stock. But I think in the long run, Intel is very well positioned to become a domestic alternative to TSMC and to be a real foundry alternative to an industry that's quite frankly extremely capacity constrained and in need of an Intel alternative. AMD has been killing Intel on market share. If Intel's new process is able to improve its competitiveness, then it may be able to stabilize its market share. And I think all of that, along with the domestic investments that we've seen from the government, from NVIDIA, from SoftBank, are all signals that are showing some improved confidence of Intel's competitiveness going forward.
Cody, I'm curious about the memory chip. I know you don't cover memory chip makers specifically. Matt, we're going to get to you on that in a second. But I am curious about the ripple effects for Intel. And we talked about this earlier today with our reporter Laura Bratton. The idea being that if memory is in such short supply that, for example, PC makers won't be able to make as many because of that could then affect the Intel chips that go into those devices as well. Are you worried about that at all?
Yeah, and Intel communicated that as much last night, saying that higher memory prices and limited availability would likely limit their ability to fully capitalize on demand for the PC market, and that unit volumes would be impacted by rising prices at the consumer level. And so I'm not expecting the client side of their business to do much this year. I expect the server demand to be what really bails them out of this doldrums from the first quarter.
And Matt, you do cover some of the memory makers. I want to ask you about SanDisk in particular. That company's reporting soon. The stock is the best performer in the S&P this year, at least coming into today's session. But it does have very high short interest. I was looking at some data from S3 Partners that showed maybe some of this upside has been a short squeeze. You're a bull on the stock. So what's the fundamental case here for something like SanDisk?
I think the fundamental case, Julie, is that, again, you go back to middle of 2025 and memory vendors just had no idea this demand was going to show up with the memory industry. The problem is always that too much supply comes on and you end up with overcapacity. But because no one was anticipating this shift in demand, there simply isn't clean room space. So to build a new facility, it's a 2-year, 3-year process. Half of the industry also supports DRAM, and they're focused first on getting enough DRAM out there, so not building NAND capacity. And so it just looks like we've got multi-year positive cycle for the NAND vendors, which we haven't seen historically.
And if it is that multi-year cycle, whether you're looking at SanDisk or a Micron or some of the other, Western Digital, for example, that it had such a big year last year, so that implies you think that can still keep going this year.
Yes, I think there's limited possibility that we get demand meeting or supply meeting demand this year. I mean, the one lone exception being some huge unforeseen demand shock, but from a supply perspective, you have the same problem in hard drives that you do in NAND, which is to build a new fab, in this case for hard drive heads, it's a 2 to 3 year process.
We'll keep watching those stocks. Thanks, guys. Cody, Matt, appreciate it.